Some other ideas you might consider: if you have appreciated stock, for example, instead of giving cash to a charity before the end of the year, you might consider gifting them that appreciated stock. That way you can get a full deduction potentially, there are some limits, but a full deduction potentially for the fair market value of the stock and never recognize the gain on the appreciation. For example, let's say you had a stock worth $11,000 and you purchased it for $1,000. You have $10,000 of gain built in. If you sold that stock first, you'd have to pay capital gains tax of 15% on the $10,000, which is $1,500. That would only leave you the $11,000 minus $1,500, or $9,500 to gift and get a deduction for. On the other hand, if you gifted the $11,000 of stock, you would get a full $11,000 deduction and never have to recognize that gain. So think about giving appreciated assets as opposed to cash. Again, there are limitations. Check with your CPA on that. Other things that you should consider is, what if the stock is underwater? What if it's actually worth less than what you paid for it? In that example, you actually would be better off selling it first and then using the cash, because that way you would obtain a capital loss deduction, and then you can use the cash to get that same charitable contribution. So depending on whether you have appreciated assets or assets that have depreciated in value, you may, again, with appreciated assets, you're better off gifting that stock or that asset, and with assets that have depreciated, you're better off generally selling that asset. Shifting to a couple of other thoughts, let's go to the pension and IRA areas. Don't forget that you have until April 16th to make your IRA contribution for this year. And for 2007, it's $4,000 for an individual. You get to contribute a little bit more if you're 50 or older, something called a catch-up provision, but at least $4,000 for each individual. For small business owners, if you've not yet established a pension plan, you need to establish a pension or profit sharing plan before the end of this year in order to get a deduction for this year. So unlike an IRA, which you can wait until April 16th, you need to actually formally establish that plan, that qualified plan, before the end of '07 in order to qualify for deduction for 2007.